Room for growth, that's our theme today as we take a closer look at U.S. stocks. The S&P 500 soared to a 10-month high overnight, and it's seen its steepest rally since the Great Depression after hitting a 12-year low back in March. So what kind of upside can we expect as the index trades above that key 1,000 level? Well, for answers, we're joined by Mikio Kumada, and he joins us live from Singapore, where he's Senior Market Analyst at LGT Capital Management. And Mr. Kumada, thanks for coming on the show today. We appreciate it. You know, we've seen some impressive gains in U.S. stocks. Of course, the Fed added to that optimism this week by saying the recession is easing. Curious, from your perspective, if this rally is sustainable.
Yes, we think from a slightly longer-term perspective, the rally is certainly sustainable, even though you mentioned it yourself. We just had a rally. If you think about what happened in the market since March, that has been the greatest rally since the Great Depression. So from a very short-term perspective, maybe we need to digest these gains for a little bit. So in the next couple of weeks or so, maybe we'll hover around the current levels to digest this. But, if we look forward for the next quarter or next couple of quarters, I think 1,200 or so is not an unrealistic target to have.
And you wrote in late July about the, quote, buying panic that seemed to overtake the markets. Do you see that continuing, this buying panic that you write about?
Well, that's the thing. We had the buying panic, my hope is that it will not continue in the short term, that we will wait for these for more economic data to confirm that whatever was discounted by the market was justified. We've seen indications over the past couple of weeks. Now it's basically much more official that we're out of the recession. Mr. Bernanke mentioned that himself, and a lot of other public officials are now acknowledging that we are in the middle of a recovery. Until very recently, that was still very much in doubt. So there was a buying panic. I think it's a possibility that the buying panic will continue, but I would prefer, and I hope, and I think that it's probably better for a sustainable rally towards significantly higher levels, that we digest the gains that we had that we booked in the market over the past couple of months.
Now, you've warned investors not to bet against the trend. Can you tell us a little bit about what you mean and what your advice would be to investors in this regard?
Yes, well, we are frequently asked about when is the right time to take profit. Obviously there is a lot of investors who did participate in the rally since March, and the nervousness there is not how to get in, but when is the right time to get out, because in general there is still quite a significant degree of disbelief in the rally. So we do get the question, when do I get out? Do I get out at 1,000? Do I get out at 1,050, which is also a level that a lot of people mention as a potential short-term resistance level in the S&P 500. We are recommending not to go short the market at any level unless you are a very focused short-term trader, a very active type of investor. But if you are, your normal investor who is looking for medium-term gains, sustainable gains, then the most conservative thing to do is just maybe rebalance at certain resistance levels. For example, at 1,050 in the S&P 500. The trend, it's an uptrend, so we wouldn't bet against these trends and just stay long and sit out any consolidations or minor corrections that the market will have from time to time.
Let's talk about U.S. corporate earnings now, because obviously they're a key driver of the market in many ways. Nearly three-quarters of companies beating earning estimates in the second quarter, but earnings obviously lower than the year prior. Do you think consensus is still too conservative among analysts in terms of corporate earnings there?
Well, consensus has shifted in the past couple of weeks. When I last looked at the earnings picture, it was about 2 weeks ago, when about half of the S&P earnings had reported their most recent quarterly results. And the general expectation on an index level at that time, the consensus was for a slight decline in earnings on an S&P 500 level. Now I checked it yesterday. I think the consensus is for growth this year, of about 10%, which of course has implications for the expectations for next year and the year after that. So you already seen a significant shift in current year expectations following the much better than expected bottom lines in the third quarter. I'm sorry, for the second quarter, for the most recent quarter that we have results. So for this year, I think the earnings expectations are quite realistic now. We will have decent growth, whereas up until very recently, up a few months ago, we still have had negative expectations for earnings growth for this year. And for next year, the big question will be whether we will not only have an acceleration of earnings growth, but whether we will, when we will see an increase in the sales of overall companies in the S&P 500 or also in other markets, which would be, of course, very bullish. And I do expect that to happen gradually. What we do need more confirmation about the general economic picture before we can have that certainty.
So we see analysts racing to revise their forecast. How should investors take all of this? What do investors believe? I know you've cautioned investors to scrutinize a variety of factors, market sectors, regions, obviously, when considering what to buy.
Yes, what we are recommending, and this is not a new recommendation, so to speak, we were recommending this to our clients since the beginning of this recovery rally in March, is never to chase the index on strong days, but because we do believe in this recovery scenario. We did believe, and we still believe, that in general the economic outlook for the G7 countries, which is where the major problems were concentrated in this past crisis, that these economies are basically still underestimated, and that growth perhaps this year and most certainly next year is likely to be much better than expected, and with the implications for the earnings, as we discussed before. So the strategy is to buy the dips during this recovery rally rather than chasing the index or specific stocks every time they do break out from a specific technical level or whatever, which is something people like to do, of course. But our strategy, our recommendation is to buy the dips and be cyclical. Have a cyclical tilt in your portfolio, meaning that you should be buying sectors or companies, whether it's individual companies or ETFs or actively managed funds. You should have an exposure to companies that benefit most, typically from economic growth, from recovering economic growth.
Yeah, you lead me right into my next question. We talk about the recovery plays here. You telling investors to buy those stocks that will benefit from the recovery. So let's get into it. Which sectors are you recommending here, those recovery plays?
Well, I mean, the recovery is, of course, a very general term, but we do think that, for example, in the U.S., the sectors that you should be looking at are, in general, technology. And within technology, I think the sectors that have exposure to nominal GDP or grow faster or are able to grow faster than nominal GDP, and that will be, for example, telecommunications equipment makers or communication equipment makers. In more general, the infrastructure plays. You would have also capital goods companies. This is a sector that has been outperforming. And also, even though that's not exclusively economic growth, the financial sector, though a bit more risky than the more traditional real economy, industrial kind of place, financials is also a sector that you do need to have at least some exposure. I'm saying some exposure because we still feel that there is still a lot of many investors who are a bit skeptical about the financial sector because of the risks involved. But these are basically the plays: technology, capital goods.
I'm going to cut you off there. We're going to continue our chat after the break. We'll be right back with more on The Edge. Well, let's get back to our guest now, Mikio Kumano, who's Senior Market Analyst at LGT Capital Management, joining us from Singapore. Mikio, let's get back to our discussion, and we'd like to talk now about markets you're favoring. You told us you prefer Western Europe and Japan over the United States. Could you tell us why?
Yes, well, in the general preference at the moment is within the G7. We like the old, developed markets rather than the emerging markets in general at this moment. because we do believe that these markets in general are underestimated. The economic outlook there is underestimated, so it's actually much better than it looks like. And within that universe, we have a preference for Western Europe and Japan. The reason being is that one is, these were until very recently and probably still are markets that people expect even less in economic terms than they did for the U.S. We had to talk about the Great Depression. That's not so long ago. I mean, I know after the rally it seems like it's been forever, but very recently a lot of people were saying we're going to have an L-shaped recovery in the U.S. and people expected even less from Western Europe. Or for Europe in general, and Japan, of course, has been an unloved child for quite some time now, for many years, in fact. But if you look at the more recent data, I mean, yesterday we had unexpected growth figures for both Germany and France. You see that it's really not as bad as it is. Plus, you have some of the world's best companies, both in terms of earnings power, certainly from the levels we are now, but also in terms of what they produce and what they can sell into a global economy that is recovering. These companies, some of the best companies in that sense, are based in Western Europe and also in Japan.
Well, let's get into that, because you've recommended ETFs as one of the best ways to get broad exposure and play the markets these days. One of the sector ETF plays that you've recommended, the Industrial Goods and Services ETF, that's the iShares Dow Jones Stock 600 Industrial Goods and Services ETF. It includes some of Europe's biggest companies, Siemens in there, ABB, you see Schneider Electric, as well as BAE Systems. Tell me why you like this one, why you recommend it.
Well, I have to perhaps correct myself a little bit. What I mean by ETFs is that they're not necessarily the best option if you want to create a portfolio, but they're an easy option if you don't want to go into the details of picking stocks. As an asset manager, of course, we do pick individual stocks. We have analysts to do that, and we have a stock selection team. But ETFs are certainly a very good way to do it if you don't want to go into greater details and if you want to spread your risk through the entire sector of region. Now, to your questions, why we do like the industrial and capital goods plays is because the main theme for the time being and for some time to come is global economic recovery. And the concentration of that recovery will be in the G7 markets, which had been hardest hit by their own crisis, which was the financial crisis. So naturally, this is where you will have the greatest adaptation of reality between expectations and reality. And the industrial sectors, those sectors that got hit most, outside the financial sector, of course, because obviously that had a systemic problem. But the industrial and consumer good, durable good companies, especially the European ones, which are in a quite strong competitive position, will do very, very well.
And one quick question. We have about 20 seconds here. The Dow Jones Stock 600 Technology Swap ETF, just very quickly, why do you like this one? Again, for those tech plays?
Well, I think the argument here is the same. You do play economic recovery, and these sectors are the best way to play that economic recovery with less risk than you have in some of the other darling plays, which include, of course, the sectors that are much more exposed to commodities and other things that are more volatile.
Makia, we got to leave it there. Thank you so much, Makia Kamada from
right.
LGT Capital.